Folks, listen to me, listen closely, something is wrong. Can you feel it? It's that knot in your stomach when you look at your 401k statement. It's that flicker of fear in the eyes of the Wall Street pros on TV. I'm telling you, the ground beneath our feet is shaking. The experts, the ones who usually speak in calm, measured tones, are now shouting from the rooftops. They're sounding the alarm. You need to hear it. This isn't just another dip. It's not a buying opportunity in the classic sense. The canary in the financial coal mine is gasping for air. We need to pay attention before the whole system comes down on our heads. I'm not here to scare you. I'm here to prepare you. My job, my only job, is to help you make money and protect your hard-earned cash. Right now, protection is the name of the game. We're seeing signs eerily familiar. Ghosts of crises past whispering warnings. The big money managers are quietly de-risking their portfolios. They're selling off the speculative froth, moving into the boring, the reliable, the safe. When the smartest guys in the room head for the exits, you don't stand around asking questions. The complacency that defined the last few years is evaporating like a puddle on a hot summer day. Panic is a contagion. The first symptoms are showing up everywhere. Let's talk about 2008, the great financial crisis. It's a scar on the memory of every investor who lived through it. We saw Lehman Brothers evaporate. We saw Bear Stearns sold for pennies on the dollar. The entire global financial system teetered on the brink. The root cause, a housing bubble inflated by cheap money and subprime mortgages. Toxic assets were packaged and sold as gold. When the bubble popped, the whole house of cards came tumbling down. Now, August 2025, is it the same? No, history doesn't repeat, it rhymes. No subprime mortgage crisis this time. Banks are better capitalized. But new bubbles have formed. Speculative frenzy in some tech stocks. Crypto madness, the meme stock phenomenon. For years, money was practically free. Now the Fed is taking away the punch bowl. Free money is over. The shaky foundation is wobbling. The swings now are breathtaking. The VIX, the market's fear gauge, is spiking. In 2008, the panic centered on banks. Today, the anxiety is broader. Contagion is coming from everywhere at once. In 2008, the Fed had ammunition. Rates could go to zero, and QE could be rolled out. Today the Fed is in a box. The safety net from 2008 is frayed. Firefighters have less water to fight this blaze. To understand the danger we're in, you have to look back. You have to study the past. Let's start with the big one. The Wall Street crash of 1929. The Roaring Twenties was a decade of wild speculation. Everyone bought stocks on margin, borrowed money everywhere. When it crashed, fortunes were wiped out, and the Great Depression followed. In 1987, the market fell over 22% in a single day. There was no single cause. Algorithmic program trading created vicious feedback loops. Automated selling triggered automated selling, spiraled down. Then the dot-com bubble. Companies soared without profits. When the bubble popped, many went to zero. The Nasdaq lost nearly 80% over 2 years. Each crash teaches a lesson. From 1929, dangers of leverage. From 1987, market structure and technology can accelerate panic. From 2000, valuation is not optional, fundamentals matter. Now we have all these elements playing together. History is not just rhyming, it's shouting a warning. If you ignore the lessons, you'll repeat them. Next, what happens when politics meets policy? Don't fight the Fed. There's an old saying on Wall Street, don't fight the Fed. The Federal Reserve controls the money supply and sets interest rates. It has more power over the market than anyone on earth. When the Fed is on your side, cheap money is a tailwind for stocks. When the Fed fights inflation by raising rates, it's a massive headwind. You simply cannot win a fight against the Federal Reserve. But Donald Trump never seemed to grasp this. When Powell began to raise rates, Trump publicly berated him. He called the Fed crazy, loco. The only problem with the economy. He tweeted his displeasure, breaking decades of precedent. Presidents historically respected the Fed's independence. This public war on the Fed was dangerous. It undermined credibility. Traders had to wonder, will the Fed cave to politics? Markets reacted to tweets, adding unpredictable volatility. It eroded the Fed's credibility on the global stage. Today, the Fed must be extra tough to prove independence. That means extra hawkish policy, raising rates even when it hurts markets. It created a political fault line that's shaking market foundations today. This uncertainty is a risk multiplier, and the tremors are still with us. On another front, tariffs and trade wars. Next, the dominoes they set in motion. If the war on the Fed was one front of instability, the trade wars were the other. President Trump's signature policy, aggressive tariffs, especially against China. The idea, protect American industry and bring jobs back home. It was a powerful message, but the reality was messy. Trade wars are good and easy to win, he famously said, but the fallout has proven costly and complicated. Global supply chains aren't light switches. Tariffs were a giant wrench in the gears. They acted like a giant tax on American businesses and consumers. Companies found costs surging for imported parts. They could eat the cost or pass it on. Most did both. That helped fuel the inflation the Fed now fights. Ports clogged, supply chains slowed, investment stalled. CEOs paused expansions because they couldn't plan for uncertain trade rules. They delayed hiring and hoarded cash instead of investing. That slow, grinding drag left us vulnerable. Decoupling from China has been messy, expensive, and incomplete. Other countries stepped in, but new chains are often costlier and slower. Retaliation hurt exporters and farmers at home. The dominoes pushed years ago are still falling. Here in 2025 we see the long-term consequences: higher prices, snarled logistics, slower growth. Let's get down to brass tacks. The data is telling a story, and you need to listen. First, look at the yield curve. In late 2024 and early 2025, we saw a persistent inversion. Short-term yields higher than long-term yields. Markets expect rates to fall later. Why? Because the market expects a recession. This indicator has a near-perfect track record. It's been flashing red for months. Ignoring it is like ignoring a hurricane warning. July 2025, S&P 500 companies revising forward earnings downward at the fastest pace since Q2 2020. C-suite executives are saying, we won't make as much as we thought. They see slowing demand, they see rising input costs, they see customers pulling back and paused investments. When earnings expectations fall, stock prices follow. Consumer confidence nosedived in Q2 2025, mortgage rates topping 7.5%, Case-Shiller showing 5 months of declines. Affordability is frozen, the ripple effects are huge. While dynamics differ today, rapid cooling is another major warning. Trouble ahead. When you've been watching the market as long as I have, you start to see the patterns. You see the same human behaviors repeating, the same mistakes. The run-up to a crisis always has a similar feel: euphoria. There's always a story that convinces people it's different. Then speculative excess, gambling, not investing. When your barber gives stock tips, that's a red flag. Next stage, the smart money quietly gets out. Insiders and hedge funds reduce risk and rotate to bonds. Indices can look fine while underlying strength fades. Central bank tightening is the pin that pricks bubbles. When credit tightens and borrowing costs spike, bubbles deflate. We are in that stage right now. Stealth, mania, blow-off crash. Classic pattern. That sequence is playing out again. The foundation is hollowed out, ready to crack. Watch the Fed. Almost every major bubble is popped by policy. As credit tightens, the economy cools quickly. Next, what this means for ordinary people, what's at stake for you. So what does this all mean for you? Not the Wall Street hotshots. You, your retirement, savings for retirement, your kids' college, a house down payment, everything is at stake. A major downturn can wipe out a decade of savings if you're not prepared. It can force you to delay retirement. Panic causes selling at the worst time. Even non-investors feel it. Groceries, gas, rent. Job losses and housing stress can follow a financial crisis. It's a brutal squeeze on household budgets. The biggest risk for the average person is panic. Those who sell at the bottom miss the recovery. History shows those who panicked lost the most. Understanding the stakes shouldn't paralyze you. It should empower you. The goal is resilience. Be able to survive and thrive when things recover. Be in a position to ride out the downturn and seize opportunity on the rebound. Your financial future depends on choices you make right now. Don't get mad, get prepared. Next, the concrete steps. Alright, enough with the scary stuff. It's time for the action plan. Now, not tomorrow, now. First, review your portfolio. Are you overexposed to speculative tech or crypto? Trim those positions, sell into strength, reduce risk, diversify. Raise cash. Cash is king in a downturn. Upgrade quality, pristine balance sheets, low debt, dividends. Think staples, healthcare, essential industrials, things people buy anyway. Don't try to catch a falling knife. Things can get twice as ugly. Make a shopping list of world-class companies, set price zones, and be disciplined. Buy in stages. Ladder your purchases. Don't go all in. Have a written plan and stick to it. Decide your cash percentage and defensive stock allocation now. A written plan helps conquer fear and greed. Review portfolio. Raise cash. Buy quality. Make a shopping list and set buy levels. Buy in stages. Be patient. If you prepare, you can ride it out. Bear markets create next generation of wealth for those ready. Be an opportunist, not a victim. Booyah! Sources listed on screen. This is analysis, not financial advice. Do your homework and consult a professional.